Are you curious about the latest news in the world of electric vehicles? Well, today's discussion is about the latest developments in Mullen Automotive's insider trading controversy. In addition, Mullen's precarious financial situation has led to concerns about its possible delisting from the Nasdaq exchange. With Mullen's stock price dropping sharply, the resignation of its accounting firm, and the company's bold financial choices, we must question whether Mullen Automotive's fortune are about to take a severe turn. Join us as we explore this issue further. Mullen Automotive, Acuitas Group, and its CEO Terren Peizer have a complex and intertwined relationship, having engaged in multiple financing deals involving equity and debt. Despite Terren Peizer's recent insider trading charge on March 7, 2023, the electric vehicle company announced an amendment to its agreement with Acuitas, wherein Acuitas would purchase $20 million worth of Series D preferred stock and warrants with an exercise date of June 1. Terren Peizer, the former CEO of OnTrack, was charged by the Securities and Exchange Commission with insider trading on March 1, 2023. The charges were related to Peizer's sale of more than $20 million worth of OnTrack shares while in possession of material, non-public information about the company's largest customer. As a result of the announcement, Peizer resigned from his position as CEO of OnTrack. The U.S. Department of Justice also announced criminal charges against Peizer for his actions. Let's get into the details. It is claimed that Peizer was aware that OnTrack's most significant client, who accounted for more than 50% of the company's earnings, had the ability to end their agreement. From May to August 2021, he sold OnTrack shares worth more than $19.2 million as part of a pre-established 10b5-1 plan set up before May. Additionally, he declared that he did not have access to material non-public information. The company declared on August 19, 2022, that the customer terminated their agreement, leading to a sharp decline of more than 44% in OnTrack's value. During that same month, Peizer created a new 10b5-1 plan that led to the sale of 45,000 shares valued at over $1.9 million. The SEC highlighted that Peizer's implementation of these two 10b5-1 plans resulted in savings of more than $12.7 million in losses. Peizer's ownership of Mullen further exacerbates the situation. A revised Schedule of 13G filing reveals that he did not possess any Mullen common stock as of December 31, 2022, but he did have warrants that could be converted into 148.55 million shares, as well as $32.86 million worth of convertible notes. In Mullen's resale filing, dated Feb 16, 2023, it was stated that Acuitas would hold only 3 shares of Mullen common stock after the offering was completed. A question arises: why does Mullen persist in collaborating with Acuitas and Peizer despite potential risks? Perhaps desperation plays a role, given Mullen's precarious financial situation. Consequently, well-regarded institutions may be reluctant to provide financing to Mullen. On March 11, 2022, the stock price of Mullen was $1.35, but as of March 12, 2023, it dropped to 17 cents. This raises concerns about whether the company will face delisting from the Nasdaq exchange due to the growing number of negative indicators. Is it likely that the stock price will continue to decrease and result in delisting? Mullen Automotive received a double blow on March 6, 2023, when its accounting firm, Dascal Bolton LLP, declared that it would be resigning. This Florida-based firm, consisting of 150 individuals, will be supplanted by a much smaller New York City-based firm, RBSM LLC. On top of this, the automaker failed to meet the Nasdaq listing compliance's minimum $1 share price requirement on the same day. When considered together, the situation is quite unfavorable. Investors have been aware for some time that both downsizing an auditor and having a share price below $1 can lead to delisting. Despite Mullen's impressive track record of consistent updates, the company's bold financial choices could ultimately result in a total loss. To gain a better understanding of this issue, let's examine it more closely. All publicly traded companies on the Nasdaq or New York Stock Exchange are required to release audited financial statements at least once a year. This is done to ensure that the company is not providing false or inaccurate information, or at least to make it difficult enough for highly skilled professionals to be deceived by the company's financial data. The publication of audited financials is crucial for both stock exchanges and investors to assess the company's financial health. It is important to keep in mind that auditors may not share the same motivations as external shareholders. This is because the companies being audited directly compensate accountants, which can lead them to prioritize satisfying management over serving shareholders. The infamous Enron scandal is an example of this, as it involved the assistance of accountants at Arthur Andersen. Similarly, the accountants for the disgraced crypto exchange FTX are currently facing allegations of being willfully blind to a scheme of racketeering. Despite this, many audit firms prioritize self-preservation. The American Accounting Association identifies litigation risk, the possibility of being involved in a lawsuit, as a major reason for auditors resigning. If a company is implicated in accounting fraud, the auditing firm is often implicated as well. Now, before we continue, please like this video if you're enjoying it so far. Stick around until the end of the video to find out more about what's happening to Mullen Automotive. Mullen's situation stands out because the audit firm handling their account withdrew its services after disclosing plans to merge with ConResnick LLP, a prominent accounting firm with approximately 4,000 staff members. Bigger firms usually have a heightened awareness of litigation risk, stemming from the fallout of Arthur Andersen's collapse. As a result, despite having a six-figure contract with Dazgal Bolton, Mullen was left without their services. The reasons are quite clear. Mullen's acquisition of a partial stake in Bollinger Motors during Q2 of 2022 involved aggressive accounting methods, as evidenced by $77 million of cash that may have circulated among related parties and optimistic estimates of patent worth. The acquisition of Electric Last Mile Solutions was also questionable, as $55 million was allocated to ambiguous terms in order to avoid classifying it as goodwill. Then there's the issue of Mullen's sub-$1 share price. A vote that was mostly predetermined took place on January 19, 2023 and approved a reversed stock split for Mullen's shares. This proposal permits a reverse split of up to 1-for-25 at any time until December 2023. Although the requirement for a $1 listing may appear insignificant, Mullen's management has expressed a desire to postpone a reverse split until all compliance extensions have expired, which could be around September 2023. Research indicates that delaying necessary actions can lead to a higher probability of being delisted. The NYSE and Nasdaq exchanges takes into consideration various aspects when making their decisions. Therefore, any negligence may accumulate. For instance, a company that has a price less than $1 and is late in submitting filings is more likely to be delisted than a company with just one of these issues. Helbiz, a former meme stock, learned this truth in January. On average, a sub-$2 company that doesn't perform a reverse split and fails has a survival period of only 6.7 months, as per a study published in the Journal of Finance and Economics. Mullen's stance in relation to the Nasdaq capital markets increases the level of risk involved. As a lower-tier exchange, it imposes extra regulations that may pose challenges for companies seeking to re-establish compliance. What's next for Mullen stock? Mullen's shareholders may find little solace in historical data, according to a study conducted by Indiana University in 2001. Companies typically experience a 4.8% decline in their stock prices on the day following an auditor's resignation announcement, with an additional 12.1% decline over the subsequent 60 trading days. The situation is even direr for companies that do not provide a reason for the resignation, as those companies experience a further 2.5% drop in share prices. Additionally, a reverse stock split can be detrimental to share prices, with a separate study showing that such events can lead to a 22.7% to 43.6% decrease in share prices over the following 3 years. Will Mullen stock recover? Although Mullen stock is unlikely to plummet thanks to CEO David Michery's successful efforts in sustaining the electric vehicle startup and the popularity of the stock among retail investors. It should be noted that the data presented is a representation of numerous companies and Mullen is not an average one. Despite Michery's successful negotiation, it is possible that Mullen may eventually have to restate its financials or lose its place on an exchange list due to the inevitability of financial loss catching up with them. Thank you for joining us today as we explore the latest developments in Mullen Automotive's insider trading controversy and the company's precarious financial situation. Do you think Mullen Automotive's fortunes are about to take a severe turn? Share your thoughts in the comment section below. Thanks for watching. I'm Fred. Please subscribe, like, and share this video. And if you want to know the reasons behind Mullen Automotive's plummeting stock price, then check out this video where we dive into the topic. So, click and watch the next video here to know more.